Hello, everyone, and welcome. Thanks for taking part in this growth webinar series, all about helping you do more business with your clients and your prospects. Today, we're going to focus on an overlooked area for a lot of advisors, which is insurance. We've talked a lot about investments. We've talked about financial planning on these things. And I see a lot of advisors just get busy in those areas. They might have a stigma of, I don't want to be confused as an insurance salesperson. But hey, listen, it happens to be the highest production or GDC producing thing that we have. So, and real certified financial planners, they do a lot of insurance because when you dig into the needs of people, it is a real need, and helping people act on it is a big deal. So I'll give you what one of the top advisors in our industry once said. They said, you can choose to accept this new business, or you can allow another advisor to choose to accept this business because someone's going to get it. So we're going to talk about ideas today that are working. You're going to hear from great advisors, great experts in our field that are seeing exactly what's working with advisors. So, hey, as we go, if you have questions, just go ahead and type it in the chat box. Would be really efficient and easy. We'll keep an eye on it there. Or, you can hit the hand raise thing. I think a lot of you may come in muted, so we can hit unmute if you have questions as we go here. But let's keep it interactive. Looking forward to hearing what you want to cover today. I know that we sent out, we were going to have Jen Osgood on. Unfortunately, her father passed away. It was really sad. It's not was not expected. So she's dealing with that. Doug Smith, my friend from up the road in North Carolina. Doug's an awesome advisor, been working with D2 forever. And Doug has been crushing it. Another advisor that's popped in 6 figures of insurance business. And so let's start with you, Doug. It's great to see when there's just a surge in this business. And you've described that, hey, it really wasn't that hard to do. You didn't have to bend over backwards doing it. It was just, bringing it up with people. So Doug, let's just start at a high level. Like, what's working for you? How did this become all of a sudden a new 6-figure part of your business?
Well, John, thanks for inviting me to be the second fiddle here. What's working is presenting it and presenting it as a financial solution, it's not insurance in my mind. It's a way to accomplish a client goal. Tim shared with me the 3G strategy, which is the 3-generational or multi-generational plan where the owner is the client, the insured is the beneficiary, and and then the client is I'm sorry, the insured is the child, and then the beneficiary is the owner, the client. And by doing it that way, the client still owns the asset. They get to accumulate cash value with the insured, which is a younger child with their age, so they're able to accumulate a lot more cash value. When that client passes away, the insured, the child becomes the new owner. And so it gets passed down one generation, and then the new beneficiary becomes the grandchildren. So we're able to really, if you think about it, you're deferring or really avoiding taxes for potentially 60 plus years. So it's something that clients really just get. So that's what we've been doing quite a bit of. If the client needs insurance, then we use them as the insured. We won't do the 3G strategy, and we'll just accumulate cash value in the client's name as the owner and the insured. But if we have an opportunity to pass it to another generation, we're gonna do that. Tim, I want to share this one thing. I was cleaning out a box of old notes from decades of collecting notes from meetings like this, and Jim McCarty had this quote that he said, until a client buys into the concept, they're not going to buy into the details. And so we talk about the concept of transferring wealth, and then we get into the details when we talk about the financial plan, and then the illustrations. The illustrations are the very, very last thing we get to.
Awesome. So it's great learning for everyone on here, listening, watching the replay video. It's not just the needs based here, right? Doug's not just going through, oh, you just bought a house, you had a new kid, maybe you get some term insurance. This is tax savings ideas, the greatest use for insurance vehicles. That's really what the cash value was invented for. You can tell that lawmakers must take significant advantage of this because they stayed in place. It's really good stuff. And so, Doug, you're helping, a whole nother level of client. You're helping, generationally. It's really a neat thing that you're doing, which is leading to a lot of new production. Now, a lot of advisors will ask, like, how do you bring this up, Doug? Like, how do you even get to this topic of this might be a solution that might help save taxes and help their kids and grandkids one day?
Yeah, so we start with, as most of you probably know, the tax control triangle. We don't usually use the stock one. I like to draw it on a whiteboard and really kind of walk through, so I can show the legs of the stool, if you will. So most people, the tax deferred leg is so big relative to the taxable or the tax free. So if you show it in that way, then they can see how lopsided their savings plan is. So we start with that, and that kind of gets them thinking along the lines of tax diversification. And then we do comprehensive financial planning. So that's been a big driver of the business, because we will walk through with a client and show them their model out their retirement, show them at age 72 that you cannot spend all the money that's going to be forced out of your plan. So we attack it in one of two ways. One, you talk about, well, maybe we should divert some of that savings that you're putting into your tax deferred plan into the 3G strategy or cash value life insurance. So that way we could bend the curve, if you will, so that it doesn't grow to be a big problem. The other way is we're going to, and that by bending the curve, what you're doing there is, you might help them so that their Social Security isn't taxed as much. There's the Medicare surcharge that people don't really know about. So anything we could do to bend the curve is a good thing. The second part is, if we can't bend the curve and it's just going to be a ton of money coming out, well, now they have a bucket that they can take those RMDs and put them into. So they're going to get these RMDs. We're going to put it into a tax-free bucket, and then it's gonna pass on to their kids or grandkids.
It's fantastic.
So we're using that financial planning as the big driver as we start drilling down and getting into the details. So they know the concept. Now we show them, all right, look at all this money and tax issues you're going to have. Okay, how do we solve it? And then we get to the life insurance illustration.
It's really great stuff. You're definitely not second fiddle, Doug. You can see how this can lead to six figures in new business. It's different topics than advisors typically bring up. If you are bringing it up, find more people to do it. It really works. And I see all the time the advisors that are doing this kind of thing with the clients love it. It's the integration, what we talked about last time, planning. Not a lot of advisors are going this deep in planning, finding these tax saving things. That is how to hit the heart of the highest net worth people. If you save them on taxes, they'll love you. They'll do business with you for a long time. So it's really great insights there, Doug. Again, easy to see how you've jumped and created this new six-figure line of business that's become pretty consistent in your practice, and it's growing and it's got even more potential. So awesome job there. Let's flip to Brandon here. So Brandon's an awesome growth coach. Brandon's got insights from how to get started with insurance all the way to these advanced strategies. He was really familiar with the things that that Jen Osgood was doing here. So Brandon, what are you seeing as some strategies that are working for advisors out there?
Yeah, I mean, I think Doug hit it on the head in terms of if you're working with planning clients, work the plan, present it. Clients that do planning are going to want to do insurance. Tax savings, again, huge. Where we're seeing a lot of singles, a lot of doubles, a lot of triples around DI. If you've got high income earners, they need to be understanding what their DI covers and how much they're going to be covered if something happens. We know the stats. We know most people are going to end up using that. Where we were hitting a lot of home runs in the past year or so is looking at one, buy-sell agreements. When you're talking to business owners, having those in place, those are big money topics. Those are big money issues, and they need to have this in place if something were to happen. I think Doug hit it on the head again with when you have clients that have assets or income they're not using, and they want to find a way to pass that along. A couple big things. One, if we talk about tax rates, where do we think they're going to go? Not many people are going to think they're going down. So estate tax, probably not going to get a ton of cuts, but also where can you put money right now that's going to be safe, that's going to get a return that's attractive? We're in a 1% or less interest rate environment. There's not a lot of options out there. Life insurance can get you a payout for your heirs that is going to be above and beyond any guaranteed income you're going to find right now. Big investors love, I got a guaranteed return. I don't have to worry about it. And I get tax savings. You pile that on, extra income, extra assets. And then the other way that you can open this up and start talking to folks, when you've got people using their group policies at work, you've got young, healthy clients, their group rates may not be anywhere able to touch what they could get on an individual policy. Group rates got to adjust to the mean. If they're young, if they're in good shape, if they're healthy, take a look at that. They're going to be able to get some policies that'll have them better coverage for a cheaper rate, and they're going to own it rather than be a participant in it. Those are some really easy ways to start that conversation. After that, it's managing the process.
Well said. Really good insights there. And you think about clients who has assets they're probably not going to use in a lifetime, who has income they're not using. What a great way to say, let's do something positive with this. Let's do something much better than we have been doing, or what they might think of. This is probably not on their radar. I tell you, it's interesting bringing up business owners. The largest new asset inflows I've seen with advisors in the last couple of years has been with people selling their business. And what a great way to get integrated here to help with the solution that if, God forbid something happened and a partner or a key person, something went on, just using the insurance to fund the buy sell is an easy in, but oh my gosh, it can lead to so much more down the road. It's really a neat potential there, but probably the lower hanging fruits is just look for clients, assets, income they're not using. Easy one to figure out something that's more tax efficient, more beneficial for them. So lots of good insights there, Brandon. Great things there. Thanks for sharing. Let's throw it over to Tim McClurg here. So I've known Tim for over 20 years, and Tim is Tim's actually wholesaler in insurance, but I think of him as like a tax and estate planning expert. So it's really neat to see his insights. Tim personally helped me produce a lot of insurance GDC back when I used to be an advisor. I just do coach consulting is all I do now, but what was neat for me is Tim taught me a little bit about this, but that's all I knew. Like Tim knows a lot. So I actually had Tim in the client meetings, which I recommend that you do, is get an expert involved to talk to your clients. You don't have to be the only one that brings value to your clients. Get an expert involved. Great people like Tim around the country, they can help you. But Tim, let's talk about what's working. You see it all. You're seeing, advisors not do business, the ones that are doing business. So what's the highlights there? What do you see in working that other advisors should be doing?
Yeah, I mean, thanks, John. Thanks for the kind words as well. Mutual Admiration Society, right? Same thing about you. Thanks for all the work you've done and business you've done over the years. The John said to me, "Hey, what's working?" And he just left it up to me. Well, I didn't know Doug was going to be on this, but what I was going to talk about was Doug's strategy. So great minds think alike, right? Right, Doug?
Well, hey, it is your strategy. I just took it and ran with it, and it's a good one.
So and I will say one thing related to one quick idea related to a buy sell. This happens to be the largest case that's ever been placed in my 23 years doing this in my territory last year. It was a $42 million VUL that was placed last year. And yeah, GDC on it was 557,000. So that was not bad. And it was a buy sell. It was originally a term. The advisor and the client were thinking term because it's a buy sell, it's temporary, so it's temporary coverage, right? Well, the problem was actually a couplefold. One is when you get into large cases like that, we're going to use reinsurers, and they don't want to put themselves at risk and go through the entire cost of underwriting for a term policy. It's got to be a permanent policy. That's one thing. Second thing is, so I just give you the example. Anybody have an idea what the term premium is? We actually applied for 150 million. He actually needs more, but that's all they would give him. It's for only 42 million. What the term premium on a 30-year term for 150 million? Anybody want to take a guess? I'll just throw it out there, but it's 300,000 annually for a term premium on somebody in his mid 40s, healthy. Okay, so I looked at a VUL 150 million, the minimum no lapse till age 75 premium on a VUL. That premium was 1 million, a little over 1 million. Not as much difference as what we think, right? And at the end of 10 years, there was about 7 million of cash value. Well, he's paid in about 10 million. There's 7 million of cash value. His net cost was 3 million or 300,000 annually. It's the same premium as the term premium. But now he has lots of different options. He might sell his business then, probably for 200 or 300 million. He's going to be looking for places to put money. He can backfill that policy and utilize it that way. He can transfer it with less hit to his lifetime gift exclusion because it's only the cash value. It's a smaller cash value. He can do that at that point. So in essence, it was a wait and see buy sell that gave him a lot of different options. But anyway, so it just reinforces. So the idea there is whenever somebody's looking at a 30-year term, run a VUL with the minimum premium. Look at what the net when the crossover point is when it's net cheaper to be in the VUL, and then give them all the advantages. So that's one idea right there. In backing up what Doug was saying, think about it like this: when you're talking to clients and getting into the conversation, talk to them about, suppose there was something crazy that happened. Think about a Roth and everything that Roth does, but all the restrictions are taken away. You can put money in from any source. Doesn't matter how much money you make. You can put money in. You can take it out. You can give it to the next generation. Your next generation can take money out. They can put money in. And because of a tax law update, it's more cost effective than it's ever been. In fact, on average, it's about 50% less costly today than it was in 2020. If you could do all that without restrictions and make it generational, how much would you want to put in there? And of course, everybody's like, well, how much can I put in there, right? Well, it's not the Roth tax code, it's the life insurance tax code. And then it goes into the strategy that Doug was talking about there. Adult parents buying it on their children. So I want to share my screen. I want to share with you the actual, well, I was going to share my screen, but it says I can't share my screen.
Sure.
Is that you there, John? Give me access.
Let me stop spotlighting here.
I was just gonna just add, like when we go through the life insurance illustration, everybody's worried about cost with VULs, and we go to the cost of insurance page. That's really the only page I even use because I want to be out front with them on what it's going to cost. And when we show cash value of like, in 20 years of $1 million, or it doesn't really matter the number, and you look at what the cost of insurance is at like $2,000 versus what the taxes would be on $1 million sitting in a non-qualified account. Just if you think that 2 to 5% of capital gains distributions off of a mutual fund, I mean it's like $2,000 cost of insurance versus like 10 to 15,000 in actual taxes that they would have to pay. And so when you
Yeah.
start comparing those two, they're like this. Why wouldn't we do this? It's not even. It's just like when do we sign up?
Right. Yeah, thanks, Doug. And by the way, Doug was top 1% in our territory last year out of 700 advisors, and he was top 2% in the nation for insurance sales. So thanks.
Awesome.
Thank you, Doug. So this comes from actually, you'll see the name is not there. It's identical to a case we implemented last year. We implemented in this one case a $4 million policy on mom. She's in her late 50s for estate planning in a trust. And then we implemented 2 identical policies on the 25-year-old, and I'll tell you why we did 2. So their total annual premium, that family, is $380,000 per year. The $300,000 per year is just going to last for 10 years. The $80,000 is going to last for 20 years, because when the client saw this and how it worked, I said, you can pay for 10 or 20 years. You can pay for 20,000 versus 40,000 each. He's like, here's what we're doing. He says, we're doing 40,000 each for 20 years. That's what we're doing. This is run at 6% net rate of return. So nothing crazy, no crazy rate of return. If you haven't seen this, this is the tax efficient retirement income report that is inside the illustration system. And we show 40,000 going in for 20 years. Once again, a lot of flexibility. It doesn't have to go in. They can stop it early. And then I just show, what if in the 25th year, because this actually could be the client certainly could be alive at that point, somebody, either you or your son, starts taking out, let's say you pull it out for yourself, 5 years. Now remember, this is the parents owning a policy on their son. So why can they pull it out? They're the owners. They can do anything they want to with it. Here's the cash value right here. So when this starts to come out, there's 1.8 million there. And I show the money coming out for 40 years. So 800,000 goes in, 4 million comes out, and we still have 2.5 million that comes back. Now, that part in my analogy there with the Roth that I said, biggest tax law change, it's the lowest cost it's been, it's 50% on average less. Here's what I mean by that. There was a tax law change. This is another important, very important factor. There was an update to the code that governs life insurance, section 7702, to where there's a significant amount more money that can go into a given death benefit today and last year than it was previously. For the scope of our discussion, won't go into details, but you can reach out to me. You can reach out to my colleagues in your territory. They can explain that to you in more depth. But I will tell you that if we wanted to get this amount of money into a 25 policy for a 25-year-old in 2020, we would have had to buy about 2.5 million to get the same amount of money.
Wow.
So with a 50% reduction in death benefit, it's a 50% reduction in all these costs and a 50% reduction in the expense ratio. And you can see here, as Doug was saying, this is the total cost of insurance for over $1 million. Now, there's other fees. There's always fees up front in policies, but still insignificant. And then once we build a little bit of critical mass in here, look at these expense ratios, how they plummet. And they really plummet after we're done putting money in, because most of that was just the 4% premium expense charge. And now it gets down to single basis points, 9 basis points. And this is what Doug was talking about. It's a pleasure to go through this, because people just don't understand how cost effective it is now to grow the money. And you can see it continues forward as a percentage. And once we get into the close to life expectancy, it's a little bit more. But for the vast majority of this policy, it's a very cost effective, plus the underlying separate accounts, which with RiverSource now, it's the first VUL that has no 12B1 fees, no M&E fee, no 12B1 fees. One of the lowest loads in the industry. I believe it is the lowest guaranteed load, meaning we cannot go back and change the policy to charge more. It's only at 4%. So That's what I wanted to share, and I'll just show you where to find the tax control triangle, and that is right here. Terry, it's under Terry Guide. This is interactive. I plugged some numbers in here, and I am just gonna. The only thing, what I put in there were some assumptions. This is their qualified money. This is their non-qualified money. This is the tax-free money. So you can draw it on a whiteboard, which I love to do. But you look at this, what you can do here. You can say, what if we started paying 0 per year into the non-qualified? We started paying $30,000 a year into the tax-free area. What would happen? And immediately it shows the difference. It shows the difference in totals. Now you have over $1 million at retirement and tax-free, and it gives you a lot more control. This is still going to be your biggest bucket because your company's contributing to it as well as you. But now you've got a lot more control in retirement and keeping more in your pocket.
That is awesome. Great tool, great concept. And you know what I like about this? It's great when there's some tax law change that makes it even better than it has been, right? I mean, that
Absolutely.
is just
Yeah.
fantastic to hear that, hey, it was going really good, but now it's going to go even better. So what a perfect time to dive into this and go. Now, one self-limiting belief I see advisors run into when it comes to insurance is this sounds like a lot of work, or I did it one time. It was really hard to do, so I'm not going to do it. But we're talking about, at least a 6-figure addition to your practice. So Brandon has got some great insights on process here. So what tips would you have here, Brandon, for advisors to run a process, talking to clients and getting this stuff through and getting it done?
Yeah, I mean, first thing is, as much as you can leverage home office for illustrations, apps, use them. They're there to help. They're there to support you. Leverage the resources that are available to you. Number 2 would be pre-qualified. Get some questions that you can ask the client before underwriting starts so that you know ahead of time, 1, if this is going to be even an option or if you don't need to waste the time, or 2, you can reach out to stay ahead of the game to say, hey, I've got a client with a couple of issues. Someone like Tim, what do I need to do to make sure this goes through? Get ahead of the game. Tim knows where the ratings will end up. You can get ahead of all of that. On top of that, then once you're moving forward with the process, let the client know exactly what's going to happen. E-sign as much as you can e-sign, but by setting up to say, look, you're going to get a phone call. If they're like me, your client is never going to answer the phone if they don't know who's calling from an unknown number. So let them know, expect a call from a maybe unknown number. Here's what's going to happen. They're going to be able to come to you where you are, your place of work, your house oftentimes. So let them know this is the process. This is what you can expect. And here for you, Mr. Miss Client, here's what you can tell them to make it super easy on your end. And give them the answers to the questions before they're going to get asked it. And it'll be smooth sailing. Once they know the expectations, they know what's going into it. That helps these things get done. Add them to a follow-up list. Have someone in your office reach out throughout the process. Still going well. Any questions? And then the last thing I'll say is control what you can control. What we can't control are the doctors and the time that they need to turn all of these these questions around. They're busy now more than ever. Let the client know we're going to get as much done as we can. The doctors, we can't control that, but we will stay on top of it. And if the client is concerned and they want to get this going, get that payment when you take the app, and that's going to get them covered while this goes in place as well. Those would be some of the things that we worked on that really sped the process up for the advisors I was coaching.
Man, really, really great insights here. So just lots of gold. Take it one step at a time. Start with what you see as the low-hanging fruit, whether it's business owner needs a buy sell, great one. Whether it's clients that have some extra assets, extra income they're not using, let's do something smarter with it than we have been doing. And what a great insight that it's all about expectations, that let clients know what's coming, hold their hand through the process. Keep it easy for them, because it's a little thing, but it can kill these that you put a lot of time into. It's usually the clients don't know what to expect. And so it's an excellent insight from everyone. So lots to dig into there, but take it one step at a time. Doug, it's awesome to see your results. And I know you're just getting started. I know there's much more to go. Tim, always a wealth of knowledge. Just absolutely fantastic stuff there. I love the new tax law change that half price insurance is the way we should be thinking about it, right? It's half price. That is tremendous to hear. So let's all take advantage of that. I love RiverSource, and whether you're in Tim's territory, like me and Doug, or whoever the counterpart may be, they're just fantastic. And if there's help you need, just getting this going, other growth coaching you need, being branded, always here for you. So I know most of you we work with. For anybody you that any of those that we do not work with, or anyone checking out the video, we're always here for you. We'll give you a free coaching session to help. But hey, it's all about growth. Add this one into your arsenal. It's at least a 6-figure line of new business. Tim shared it. One piece of business end up in $500,000 in new production with one case. That's what we're talking about here. They're waiting for you. They're out there, and let's reach out and get it. Everyone stay bullish, stay awesome. Keep us posted on your results, and keep pounding here. We'll talk to you soon.
Thanks, John.
Thank you, John.
John.